Finding a stock to buy is easy, but picking the right one without strategy on the market can prove to be incredibly difficult. So, what are the best stocks to invest in now or to watch over the upcoming period? If you like to do research or make plans before you move, the best stocks in the market where most people invest must be next in line in your must know list. Luckily for you, Fortune Fastlaner, we've produced a list of the top 5 stocks you need to invest in right now. Remember that while the first step is completing this amazing video, the second and possibly more important step is taking action, even if it's imperfect action. Actually, we are able to analyze the portfolios of investors that have a lot of money because they must disclose their assets at least every 3 months. The SEC is the agency responsible for preventing market manipulation, and this disclosure rule gives us insights into what these market movers are buying and selling. Here are the top 5 most well-known stocks bought by investors on our list. Number 1. Amazon. In analyzing stock prices, it is detected that Amazon had the highest buy-in. This company has a market cap of over $1.6 trillion and is one of the highest traded companies in the world. Okay, that's trillion with a T. The company had total revenue of $470 billion in 2021. This was nearly 22% revenue increase from the year 2020, which, as I'm sure you know, was a huge year for online shopping as everyone was stuck at home. One of the most impressive things about Amazon is that it has been able to grow so fast despite its huge size. As companies grow larger, their growth rates tend to slow down, and online sales make up more than 50% of Amazon's revenue. Third-party seller services account for over 20% of revenue. Their profitable cloud computing platform, AWS, accounts for about 15% of revenue. Subscription services, advertising, and physical stores represent the remaining revenue. Amazon is currently trading at a P/E ratio of around 70 times. Amazon is currently trading at a P/E ratio of around 70 times. However, this number seems like a high one compared to the S&P 500, which is currently trading at a P/E ratio of around 24 times. For Amazon, its P/E ratio in 2018 was nearly 250 times compared to the current P/E ratio being near 25 to 26. One other thing to keep in mind is that Amazon sees incredible earnings growth, with the company making profits per share of $46.7 by 2021. And by 2025, the project earning per share reaches even higher than the estimate of $132. The reason that its price-to-earnings ratio has declined dramatically is because even though Amazon has grown tremendously over the past 18 months, its stock price remains unchanged. It is currently trading at around $30,200 per share, the same price it was trading at in the summer of 2020. Number 2. Mastercard. Next on the list is Mastercard, with the symbol MA. More people know about Mastercard than you might think. It sounds like everyone has a Mastercard in their wallet, but few actually know how the company makes its money. The most famous product of this world-renowned brand are credit cards. Some people aren't sure it's a credit card company, but Mastercard is one of the biggest names in the world. Though it's true that the Mastercard brand is one of the top worldwide labels for debit, credit, and prepaid cards, Mastercard doesn't really consider itself to be a credit card company. Mastercard is able to generate revenue from fees paid by its customers. Many of these customers are financial institutions such as banks that pay a fee to issue credit and debit cards with the Mastercard brand. This company has a market cap of $340 billion and a P over E ratio of around 42 times. Running a payments network does not require a ton of investment in physical assets like factories. As a result, Mastercard produces tons of cash flow. The company's free cash flow or margin reached to 48% in 2021, earning a return on equity of 39%. This is significantly higher than Home Depot's, which was 9.2%. The company made $9.1 billion of free cash flow and $18.8 billion in revenue in just 1 year with its Mastercard credit card business model. What investors value this business highly for is the fact that it releases high amounts of cash into their shareholders' hands, thus giving them high return on investment opportunities. In today's market, it has never been more difficult to find creative and lucrative investment opportunities. But if you want to be happy, you need positive cash flow. The annual inflation rate has hit its peak in 40 years, and real returns have been negative since November of 2021. Reducing your portfolio with necessary overhauls is essential to success. Number 3. Meta, or Facebook. The next most controversial stock on our list of super investors is a Meta platform, ticker symbol FB, or maybe you know it by its old name, Facebook. This is probably the second most controversial stock on our list of super investors. Some people think that the stock is a screaming buy, while other people think that the company will continue to tank. The most peculiar thing about the last stock on this list is that it has met a beat with just a little bit of Meta. This stock is well known for what it refers to as its quote family apps, which include Facebook Messenger, Instagram, and WhatsApp. These 3 apps have over 3 billion monthly active users, so if you have internet access, you're using at least one of these apps. The social media platform also has many monetization options for advertisers. This can provide companies a variety of advertising opportunities, including location, gender, age, interests, and behaviors. Advertising on Meta is down over 40% from its September 2021 highs due to concerns that competitors such as TikTok are stealing away customers and that the shift towards shorter videos like Instagram Reels and TikToks may reduce the demand for ads by late 2021. Another concern among investors is that the company has invested heavily in the trend of meta making, but it is said to be performing poorly. The reason for this is that the metaverse Facebook Reality Labs lost $10.2 billion in 2021. The losses continued through 2022 and had a negative effect on the stock price. As a result, their PE ratio dropped from 35 times in 2017 to 15.7 times. This lower PE ratio was lower than of the S&P's 500s, which indicates that metaverse social media has become an overall less attractive option for investors than before. And this low price-to-earnings ratio is why many investors are saying that the stock is too cheap to ignore. Number 4. Visa. The next stock on our list of top investments is Visa. Now, I won't spend too much time describing the company's business model because it's awfully similar to that of Mastercard, which we discussed earlier. Visa and Mastercard essentially have what is referred to as a duopoly in their industry. This means that an industry is controlled by 2 big players and every other company is fighting for the small percentage of market share the 2 big players don't control. A well-known example of a duopoly is Coca-Cola and Pepsi, and the soft drink industry. Based on research, the stats say that Visa and Mastercard together holds over 90% market share of all transactions made on credit and debit cards in the US. With 40% each, Visa controls 60% of the market, while Mastercard has just 30%. Well, you won't think of any other industry with those two companies having such a huge market share. Visa's stock price is around $220 a share now, down from its all-time high of around $250 in the summer of 2021. Mastercard has a market cap of around $340 billion. In stark contrast, Visa's market cap is over $500 billion today, and their revenue is greater than that of Mastercard too. Visa also generates an amazing 56.9% free cash flow margin of their revenue, which is the highest you will ever have seen for any business, excluding for Mastercard, with lots of available cash flow to pay dividends or buy back shares. Due to highly scalable business model, there is a low cost of operations and high revenue, which allows cash flow. Number 5. Alibaba. The next stock on our list is one of the most polarizing stocks you have never seen before. There are two sides to this debate. One group that sees it as a once-in-a-generation buying opportunity, and the other side that sees the stock as having a significant risk of going to zero. That stock is none other than Alibaba. Alibaba is China's largest e-commerce company and has been described as the Chinese Amazon. One very prominent investor has made a large bet on the company. That investor is none other than the legendary Charlie Munger. This was one of the first times Munger had bought in years and was noteworthy enough that you would want to see a whole video about it. The bull's case for Alibaba is pretty straightforward. China is an absolutely massive country with 1.4 billion people. Along with China's economic growth and the million new internet users that join daily, Alibaba has been able to increase revenue year by year. This comes from the country's start of GDP growth in 2008 and its annual GDP growth over the years since then, reaching a high of 41% in 2021. Admittedly, the valuation of Alibaba is one of the reasons some investors would support. At a P/E ratio of 15 times and a market cap of $290 billion US, Alibaba has a strong case when compared to Amazon, at a P/E ratio of 69 times and with a market cap near $2 trillion US. The difference in valuations between these two companies can be attributed to what each company does differently. On the other hand, there are the bears. These are more speculative investors who would invest in Alibaba's stock. They would use the argument that the stock is cheap for a reason, and many investors are concerned about the risk of not being able to make a profit by purchasing shares of Alibaba stock. Alibaba stock has recently traded at around $310 per share since then, and investors now see that the company will likely face significant challenges with China's regulatory authorities. The current retail value of those investments is around $100 per share. The Chinese government has put limits on certain sectors' profitability in an effort to improve the country's economic climate and their own profits. This includes banning online tutoring companies that provide tutoring services for Chinese consumers, resulting in investors losing nearly 100% of their money. When this happened, investors were scared from investing in stocks as well. Alibaba's shares have fallen as a result. Now that we have learned about the top 5 stocks you need to invest in right now, you might also want to know the stocks to put on your watch lists. Are you ready? For successful investment, be sure to consider companies that have newly developed products and services and those that are generating a significant amount of revenue. The CanSlim system provides clear guidelines on what you should be looking for. Invest in stocks with quarterly or annual earnings growth at least 25%. Look for companies that have new products and services, and consider not yet profitable companies with recent IPOs who are quickly becoming major players in the market. Once you have found a stock that meets your criteria and has charted a base, it is time to move on to buying the stock. You should wait until the stock begins trading and then buy when it reaches the proper point, ideally in heavy volume. A good high point on the left side of the base indicates that the stock is ready for a price increase. More information on what a high or low point are, or how charts can help you find stocks, can be found here. Now we'll take a closer look at Apple stock and Merck stock. Apple. Investors could view 179.71 as a buy point, either from abnormal handle and an entry point or the beginning of an upturn. Apple stock has just lost ground, now trading below its 50-day line and below its 200-day moving average amid significant pressure. With Apple looking like the top performer in a weak market, the relative strength index is at all-time highs. The RSI, which gauges how a stock performance compares to the S&P 500, has skyrocketed. Apple stock is one of the strongest companies in the index. With the market now going on a downturn, AAPL rose above $3 trillion earlier this year and has now fallen below that mark. Merck stock formed a cup with handle base and was able to hold up nicely against Thursday's pullback. The entry point for Merck stock moved above the level last Friday, only to be pulled back under the entry price. However, MRK stock was already actionable. The relative strength line has hit a 16th-month high, suggesting the breakout will continue to succeed. This is reflected in its near-perfect IBD composite rating of 98. Big money has been snapping up the stock of late, which is why it holds a powerful accumulation distributing rating of A-. Earnings are strong, with EPS coming in at 93 out of 99. Nevertheless, the stock has increased around 90% over the past 12 months. While it is good to know about these stocks, the CanSlim formula is still the most effective when applied during market upswings and corrections. The M in the CanSlim acronym stands for market. Buy stocks when they're going up, sell them when they go down. The market is in bad shape. This means you should avoid buying stocks altogether. Instead, it is a good time to start raising cash. First, by selling the weakest performing stocks that you own. If you have great conviction about a stock and have a profit bank, see if you can hold on through the correction. You also move entirely off margin. And that's it for this video of Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for all the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!